Awesome. All right. So, everyone, appreciate you jumping on the call. Today's mortgage chat with Ian is credit scores. So, an interesting topic, one that did come as a request a while ago. It was a sub topic that I've had on some past calls, but today we're going to talk about credit scores and what actually moves the needles because there is a few misconceptions in the credit space on what can help a client, hurt a client, so on and so forth. So, that's going to be today's topic. Ah, there you go. All right, so a 20-point swing is the difference between your buyer qualifying and your buyer waiting. So we all have had experiences in the past where we've had a client that wants to buy a home, they're motivated to buy a home, but for whatever reason, their credit is a little off of where it needs to be. It may be right at the mark that's minimum for the program guides, but the automated underwriting doesn't like their credit score, or they could be needing down payment assistance and they're a little shy of the level of credit that they need for that specific program. And so we've got a history of clients being motivated, wanting to buy, but for whatever reason can't. So part of our job as a lender is to help your clients be able to improve their credit so that they can be in a what I call a mortgage ready position. And to be honest, most of what people believe about credit is wrong. And so for you agents, it's important to at least understand the basics of scores because you're likely to be in contact with these clients before I am. And so if you get a client, especially for those that work with internet leads, that says they have a bad credit score, some of this basic information may be helpful for you encountering any objections that you get involving credit. So what actually builds a score? So every credit score comes down to five things, and two of them decide the most of it. So the two categories that provide the most impact for buyers is going to be payment history and amounts owed. So you've got 35% of your scores based off payment history, 30% is off of amounts owed. So we're talking payment history. We're talking about payment schedules. Are they paying on time? Are they delinquent? Have they missed a couple payments? So on and so forth. And then the amounts owed, how much of your limits are you using? So, if we've looked back at our, Rolodex of clients, we've all encountered clients that have maxed their credit cards and, consistently only paying the minimum payments. These types of clients are going to have a lower credit score, unfortunately, because they're on the upper echelons of their limits and they're not paying down their balance, which is deemed risky. The next important category is length of history. So, this is an unfortunate one, but one that makes sense when you think about it. But length of history is important. If you have someone with a very short credit history, there's not a lot of data to build a score on. So clients that have just opened their first credit cards, those clients are going to have a lower credit score, even if their payments are early and on time, mostly because there's not enough length of history to really assess them through good times and through bad. So, a short credit history can result in a lower credit score. Longer credit history with good standing is going to result in a much higher credit score. And that leads us into new credit. So recent applications and inquiries. If clients, are looking to expand their credit history and they're opening or filling out new applications for different types of credit and then applying for a mortgage, we see that. And if they're doing a bunch of those, it will pull down the score, especially if it's a variety. It's a credit card, it's a car, so on and so forth. That'll pull down the score because it shows that they're interested in opening more lines of credit. And without establishing that history with those new lines and seeing how they can, do their payments, if they're going to be on time or delinquent, the credit models are going to score them with an increased risk factor, which will decrease their score. Now, the last category is credit mix. So, for clients that don't have a mix of types of credit, so maybe it's your client that just has a credit card or client that just has like a car payment, these clients are never going to get great scores, at least not easily, not with, a normal length of credit history. I can tell you there's a massive subsect of people who don't love credit, and so they try not to borrow credit. So when they do open credit, It's usually, some sort of installment loan. They stay away from credit cards, and they really only pay it for a short period of time before the debt's paid off, and they don't reestablish any other credit during the time until they need it again. These types of clients are going to struggle with having a good credit score because if they're not consistently dealing with credit, there's not a great history that can be assessed with these algorithms. And so those clients will, despite being debt free and making their payments early often, or at least on time during those schedules, will see that a bigger challenge than others who are consistently borrowing credit on their credit score. So what can you do to move credit in 30 days? So let's say we have a client who comes to us, you as a realtor, me as a lender, and they say, hey, Ian, I want to get a home, but my credit score is X, right? And I need, to get it up based on what you told me for the program. So for these types of clients, a lot of times I'll analyze what's on the report, right? So I'll look at, is there things that we can actually do? A lot of clients' credit scores are based off their credit balances. So if they have money to pay down their balances, that's a very quick and fast way for us to be able to increase their credit score. Another way is for the same clients is just to have a limit increase. So if they're close to the limit, let's say they got a credit card in college or earlier into their professional career, and it just has a low limit, right? Let's say it's a 500 limit or a $1,000 limit. And, normal expenses, as we can all imagine in today's world, are definitely at that, if not more. They just may need a credit limit increase to keep them from being so close on their utilization. So, we look at that, and we'll, particularly if we notice something like that, we'll make the assessment that they should request that. Now, there's no guarantee that they'll get the limit requests approved, but if they can, this can be a great way for them to improve their credit. Another thing that does pop up is sometimes there's errors, right? Credit is not perfect. There is a lot of errors that can happen in the credit realm. And so for clients who, when they're reviewing their credit report with me, notice an error, well, that's something that we'll dispute. And then once that dispute is resolved, we will do what's called a rapid rescore. Rapid rescores are very popular in the mortgage world. For you realtors that may not have heard of this, whenever a client does something to improve their credit, we want to boost their score before the next credit cycle, we'll do a rapid rescore to do that. And that's essentially where we take whatever they've done, whatever documents they can provide to show, so pay down the credit balances, increase their limit, or remove an error on the report, and we'll send that to the creditor, who then confirms that this has been done, and then through the algorithm within the credit reporting industry, we will boost their score even before the next score update is done on their 30-day cycle. Lastly, and this one I gotta say with an asterisk, become an authorized user. So this has been a very powerful tool to improve someone's credit that we've used for years, okay? As far as I've been in this business, I've been recommending clients to do this. I say that we say this with an asterisk because there is potential that the scoring models of tomorrow, not literally, but figuratively, are likely going to nerf the impacts of authorized user accounts on borrowers' credit scores. So for now, it's not nerfed, but in the future, it's likely to be. And when that is, this will not be part of my recommendations, or at least not in the same way. But currently, adding someone to an authorized user account where the user account has been open for a long time and has a good credit history is a great short-term way to boost a client's credit. I've done this time and time again. There's also some simulations on if the client has thin credit and their only credit is an authorized user, this could be a problem. But for clients to have some form of credit history and they just need a boost, this is great. And I've seen this done many times with clients, parents, spouses, etc., and have real effects. So there's things that can cost our buyers money, and I repeat, your clients are going to pay for this if they feel like these inaccuracies are true. So a lot of pushback that we get from clients, especially the years before, has been checking my credit hurts my score. Well, I do everything under a soft credit check, right? And so when I'm doing a soft credit check, I'm not hurting your score. I'm looking at your live situation, and I'm making a determination based on your live situation with a soft credit check that has no hard inquiry. if we can do a loan or not. And then also, if we can't, what do we need to do to get there? And so for clients that are just very hesitant to have any form of credit check done, it makes it harder for me to do my job and to be able to make recommendations for them. And so, it's important for my clients, and I tell them this, that we do a soft credit check, and I'm here to help. Shopping for lenders in a short window is something that even if you do hard credit checks, doesn't hurt the client's credit. They'll get that one credit pull, and then in that short window of time, they can talk to three, four, or five lenders and not see their credit score drop dramatically because they did that. There's provisions within credit score modeling that when clients do lender shopping, it's not going to hurt their credit as long as it's within a short period of time, couple weeks, and within reason. If they go and do lender shopping and car shopping and ring shopping, they're definitely going to see their score drop. But if it's just lending for a mortgage, they're going to be fine. I've seen clients say that carry a balance will build credit. This is absolutely not what you should be doing. You should definitely be trying to make the full payment of your card if possible. Paid interest does not look better for credit scores than not paying it. So what I mean by that is if I pay my full balance, I'm not paying interest on that. And there's no difference really in how the scores are modeled from me paying the full balance to maintaining the balance. And this, if you're doing this just for the sheer purposes of trying to build credit, it doesn't work and it's just going to cost you money. So you don't have to carry a balance on your credit cards on a monthly basis to build credit. Another myth I've seen in the past is close old credit cards to look responsible. So shortening how much potential debt one can have might sound like the right move. It's actually not. What we look at from a mortgage standpoint is what is your score? And then from a debt to income ratio standpoint, we're looking at what do you currently owe. So if you have old credit cards that you don't use, you don't owe anything. So we don't count that against your debt to income. What we're going to look at again is going to be your credit score. And if you're closing old credit cards to look responsible, fun fact, your credit score is going to likely drop. Whenever you open or close credit, there's a short period of time where you have a score drop. And until, some things are met, as far as reestablishing your credit or stabilizing your credit or whatever the case may be, your score will be temporarily reduced. And so I don't, of course, when clients talk to me, I don't advocate for closing anything. I always tell them, hey, don't change anything more than you already do until we've had a chance to go over and kind of discuss a plan. So closing old credit cards to look responsible, definitely not something you want to do. Another myth I've heard is one late payment isn't a big deal. As much as I'd love to say that it's not a big deal, unfortunately it is. The way that scores are modeled is it takes recency into account. And if you have a late payment reset, you're going to have a pretty big impact on your credit score. As things season, so months go by from that late, it gets a little bit better and you will see the credit claw back to numbers that it was previously or close to it. It's going to take time. Time is something that, unfortunately, when you have negative credit, you need in order to boost the credit score. So it is false that one late payment is not a big deal. It definitely is a big deal. And I always advocate clients, especially when they're trying to get pre-approved or plan, don't be late. So a 12-month plan for clients. And not every client is mortgage ready. And when they're not mortgage ready, I come up with a plan. Sometimes it's 3 to 6 months, sometimes it's 6 to 12. More often than not, when a client's not mortgage ready, they're signing a 12-month lease again. And then, because of that, we just do a more elongated plan. Not always. Sometimes there's short-term options to be able to improve in the short term. But if we're doing a 12-month plan, we talk about the first months in different cycles. So months 1 through 3, we'll pull all 3 credit reports, dispute every error that they find, put the accounts on auto pay so nothing slips. That's our first order of business. Months 4 through 6, we want to make sure that they get their balances under 30% of the limit. That way, they're not pushing their limit utilization too much and hurting their credit score. We want them, if they're going to maintain a balance, we don't want you to, because of course you're paying interest on it, but if you're going to maintain it, we want you to be closer to 10% versus 30, but definitely under 30. So this is months 4 through 6. Months 7 through 9, again, we're keeping old accounts open. We're not getting new inquiries. We're letting the history on the payments and the utilization and all that do the work. And by month 10 and 12, the buyer is going to be ready. They're going to definitely have noticed a big change in their credit profile if utilization was the big thing. And so months 10 through 12 is when we get them pre-approved or get ready to get pre-approved, and we get them set up for their next stage, which is buying a home. Building credit from zero. So as I've touched on, some credit or some clients are just not had credit, right? This is, an unfortunate reality. A lot of people, especially parents, will tell their kids, not to take credit cards out or, whatever, don't maintain debt because it's the responsible thing to do. And although, by not having debt and not opening accounts like that, you take away the urge to spend outside the means. Credit's a very important part of society. And especially with mortgages, we want to make sure that we help clients, be in a credit ready position. So building from zero, first recommendation is always a secured credit card. A secured credit card is going to be absolutely number one thing that we're going to tell the client to do. I tell them, go to your local bank that you bank with, let them open this up like tomorrow and let's get that started. If you don't know what a secured credit card is, it's essentially where you put a small deposit to hold as collateral for the bank, and then they'll issue you a credit card up to a certain limit. Usually it's relatively small. And so the idea for these cards, don't maintain a balance, pay them off monthly so that you're not pushing utilization limits and hurting credit even though you're trying to build it. Again, going back to it, at least at the current time, becoming an authorized user. So simultaneously, while opening secured credit, I'm going to advise a client to become an authorized user on account. Typically, the age of clients that have no credit are kids, their 20s, young 20s, mid 20s, something like that. And so naturally, they may not have a spouse, so a lot of times we're going to recommend that they add themselves with a parent, as long as that parent has a good credit history on that account and they pay it monthly. There's no harm to our client. If they already have a spouse and the spouse has something similar, we'll obviously recommend that as well. But regardless, becoming an authorized user is step 2. There are credit builder loans, so you may have seen these advertised online. Credit union sometimes will offer it. They'll have a small loan and savings where payments are made, and it builds a payment record, and the money is released at the end. These are options for sure. And more recently, we've seen report rent and utilities as an option as well. There's several services where you can add your rent, your phone, your utility payments to credit. And as long as you're making those bills and payments on time, it'll help improve your credit score. And so this has definitely been something that I've been recommending as part of the overall plan. I would say if you have a client that opens, at least does three of these check boxes, within 6 months, they should be in a credit ready position to buy a home. It takes, 3 months to get a credit score, 3 to 6 months to continue building. 6 months, you should absolutely have a client that's ready to go. So if we have a client with thin credit and we want to get them mortgage ready, what do we do? Again, 6 months. As I said, 6 months is an awesome timeline to prepare for. They're not going to have a perfect score, but they're definitely going to have a good score. And that will put them in a position for a lot of different lending options and, have them in a purchase ready position to buy a home. We always recommend that they use very little of their limit, so definitely keep balances under 10% or pay off monthly. Definitely pay on time, set up auto payments, and don't add too much credit too fast. We don't want to see that either. So starting with the basics as I went over on the last slide and kind of working our way up. But I've done this with clients for the last 11 years and have had really good results with those that listen. So this is a time and time again proven method. So what happens if we have to come back from a credit event? So bankruptcy and foreclosure, it's not the end of the road. The different main loan types have different waiting periods. So for conventional, we've got 4 years on Chapter 7 bankruptcy, 2 years on FHA, 2 years on VA. Chapter 13 comes with a stipulation for conventional of 2 years, the stipulation of 1 year for FHA. Same goes for VA. Foreclosure, 7 years for conventional, 3 years for FHA, 2 years for VA, and then short sale deed in lieu is 4, 3, and 2. Now, why these numbers are helpful They do change every once in a while. Guidelines are rewritten, but it's good to know if your client's just being honest with you up front. I still encourage you, even if they tell you that they've had a bankruptcy or short sale or foreclosure, to still connect them with me. That way I can kind of plan out, a scenario for them so they can make their plan together. But more than that, conventional FHA and VA loans are not the only loans out there. There are alternate loans that, are not your traditional mortgages that may not care about having 4 years or 2 years or even 1 year of seasoning for these events. And so if a client has certain conditions met, they may be eligible for those loan types. And so in the spirit of keeping buyers mortgage ready, it's important for me to be able to have that time with them so that if they are ready, I can correct that. But if they're not, build out a plan with them. So credit repair is something that's a bit of a hot topic. And when I recommend credit repair, it's usually because what needs to be done is beyond traditional work. Okay. Credit repair is for clients that have had significant derogatory account histories, have had some sort of major credit event. Um, it's not something that I want to always recommend because it costs money and it does require the client to follow very explicit instructions, and it's not always foolproof. But what credit repair does is it disputes inaccuracies or unverifiable items on their credit, negotiates payoffs, pay for deletes on collections, and requests goodwill removals on isolated late payments. When the errors come off and the real accounts get resolved, you do see results. And honestly, a lot of creditors, are willing to help out if they can get something back in return. Not every creditor is going to be so willing, but I've seen a lot of clients get through, especially negotiating payoff and pay for delete situations. I've seen a lot of positivity come from that. And credit repair is a great option to help with that. I know a lot of clients have found results in working with AI to do these things, and that's okay too. Credit repair doesn't have to be a credit repair company. It can just be, following explicit instructions with AI. But the challenge is uploading your specific credit history to AI is not safe. And so it's a little hard to get the right advice with not being able to upload like a credit report. And so that's the hard part with utilizing AI. But credit repair companies do exist. I do usually, if a client asks, I recommend a company called Kate Credit Repair down in Plant City, Florida. Been referring clients there for the better part of 10 years now. After I first was introduced to them, I get no money from referring clients down there. The only thing I get is clients that have positive credit history changes. And that makes a purchase-ready client. And a purchase-ready client is a buying client. So I usually refer them down there, and they do a good job. What to watch out for with credit repair: no one can legally erase accurate or current negative information, right? So if there's a company that says that they can absolutely do this, it's usually a lie. And it's there to get the client to spend money. There's a lot of potential issues with some credit repair companies, which is why I only recommend that one company, because I was able to do good due diligence on them. But anyone trying to sell you a 700 credit score out of nowhere when you're in the fives, usually watch out for that, because that's not usually feasible. And why does credit repair matter for you as agents? Well, sometimes your clients are not going to be purchase ready in 12 months with or with a prescribed plan that I had shown you in previous slides. And so if they have very negative credit history, but they want to buy the next 12, 24 months, they may need to do credit repair. There's certain things that are just going to hold their credit down for a long time, especially if they're currently delinquent and not making any payments, right? So getting them through the credit repair process so they can go in and start working on that kind of stuff, it may take time, and it may take more than 12 months, but at the very least, if they're motivated and they want to do it, there's a chance we can get them there, and credit repair may be the only way. So this is important to you because credit repair for some clients is the only prescribed method that's going to get them where they need to be in a relatively modest timeline. Now, on a positive, let's say our clients are purchase ready and they're under contract. What do we tell them as lenders? Well, as always, no new financing, no car, no furniture, no store cards, definitely no engagement rings. I've seen this a few times in my career. Scary one time, detrimental the next. Definitely, with clients, it's important for them to know that, during this time of being under contract, let's just keep everything the same. If you absolutely have to buy something with credit and you need credit, let's talk about how that can potentially impact you. Sometimes it's just extra documentation, sometimes it's blowing up the loan. But every client's going to be different. But generally speaking, no new financing. Do not open or close accounts. We don't want you to make any credit changes while we're under contract. When you're done with the contract and you're in your house, that can be a completely different story. But while we're under contract, we don't want to rock any boats. Um, Definitely no large unexplained deposits. I know this isn't exactly a credit thing, but again, it comes back to keeping clients under contract and clean, and then never miss a payment. We don't want you to miss payments. There's a lot of reports that we get as lenders, even while you're under contract, that can update credit histories or notify us of a collection that's been levied against an account. I actually had this happen very recently where a client literally went into collection the day he went under contract and I got a notification on it. So it's one of those things that this happens, and when it happens, we have to figure it out, right? And that client did a pay for delete situation. He was able to negotiate for less and figure it out. But at the end of the day, these things happen, and it's best to not happen because we don't want to rock the boat and cause any contract issues. But I hope this has been valuable. You and your clients, none of us can control the Fed, but what we can control is credit. They can control it, and as long as they make their payments on time and keep their balances modest and reasonable, they'll have no issues being purchase ready. But part of my, commitment to you all is helping each and every one of your clients, maintain their credit, plan for credit, and of course, put themselves in a position to buy. So if there's any questions, more than happy to take those questions now. If not, as always, I'll make this available as a recording. You can access it via my link tree. And when you want to go back and look at it, if you would like to, it will be there and waiting.
Thank you.
Of course. Did you get value out of that, Andel?
I did. I did. I got a lot of new terminology, and I mean, I have some basic understanding of it from previously doing real estate, but it certainly was good to have a refresher.
For sure,
And
for
and you
sure.
and you covered some things that I had not covered before, so that was good.
Yeah, well, I'm happy that I was able to cover some new topics. Remind me, and I'm going to stop my recording now. Um, your history